In this session, we'll have an introduction to central counterparties, what they are and how did they handle the systemic risk, what is the systemic risk per se, what are the main functions of the central counterparties, what do we mean by multilateral netting and how the CCPs play a role in the multilateral netting, how many CCPs are generally required, on what factors we look at the optimal number of CCPs, what are the different kinds of derivatives that are worth clearing through the central counterparties, then who are the clearing members, who are the various participants in this CCP market, then what do we mean by margin in the context of a CCP, what is a variation margin, what is an initial margin, what happens if a CCP member defaults, how does a CCP play a role in that, what all can CCP do in case a member of the CCP defaults, then what are the other different kinds of risk mitigation mechanisms that are followed by the CCP, wherein we will be talking about the reserve funds, the capital calls and the loss mutualization process, and what are the additional advantages that are being brought in by the CCP, and did the CCPs fail at all in the past, and if at all they have failed, what all are the lessons that we are learning from their failures now. Then just we will spend some time in terms of understanding what is homogenization and how does CCP play a role in terms of homogenization. Then what do we really think about a CCP really failing? Can they really fail? And if at all they fail, what are the kind of consequences? And towards the end, how is the CCP market growing? And to the growth of that CCP market, what are the hurdles and challenges? So here, if you are looking at all these things in a nutshell, it is basically getting a good understanding of the central counterparties. So, before moving ahead into the central counterparty understanding, we really need to see what a systemic risk is. Today, or probably during the time of the crisis as well, it is one of the major concerns in the OTC derivatives market. And what we are saying, what is that systemic risk? The financial system becomes completely unstable. The entire financial system of the country becomes unstable because of a kind of a chain reaction, because of the financial distress that is being faced by these financial intermediaries. So it's like a domino effect. So one large financial institution fails, but because there is a lot of interlinkage between the various financial institutions, if a financial institution or an intermediary is failing, it will have a ripple effect. The failure of one financial institution will definitely invoke some kind of knock-on effects on the other institutions and other participants in the market because of the interconnectivity between them. So, which means there is an initial spark that is created by one of the organizations by failing, and there is a chain reaction that gets initiated because of the interdependency between the various organizations. And as a result, the financial system of the country gets exploded, or it could have even a global consequence as such, because the participants can have linkages with the various other financial institutions across the world. So what could be the alternative to reduce the systemic risk? Probably from a regulator's perspective, there can be very stringent capital regulation mechanisms or a supervision from the regulators, a prudential, cautious supervision kind of a mechanism from the regulator can very well reduce the default risk. But at the same time, it can hamper the growth. So there should be a real trade-off. Why can it hamper the growth? Because you are not allowing the financial institutions to be as much innovative as possible. So there is no motivation for growing among the financial institutions. So it has to be balanced properly. Then the OTC derivatives typically have so many mechanisms which can reduce the risk. They get into netting, they have collaterals. So there are different ways in which the counterparty risk can be minimized. But as long as they are going well with a couple of counterparties, that's fine. But typically, just like in the crisis as we have seen, in spite of having all these things, there was a systemic explosion. Because of this interconnectivity between the various financial institutions, the exposure that we are talking of could go to such an extent that all these things, instead of minimizing the counterparty risk, they are exploding the entire systemic risk. So we have to be very careful when we are looking at all these methods being engaged. So what is the main solution for handling this systemic risk? There should be a kind of a periodic explosionary management system. So at regular intervals of time, there should be a kind of a controlled kind of intervention. So this is where the central counterparties are typically being looked at. We know that the central counterparty is going to guarantee the losses, and because of the concept of a loss mutualization, one of the major properties of a central counterparty, whatever is the loss that is arising by the one or more of the other counterparties is shared rather than being concentrated among one single organization. So it's a kind of a virtual insurance that is being provided by the central counterparty against the default of one or more counterparties. So that is how it has been observed that CCPs play a very important role in handling the systemic risk. Now, this is where we will look at the perspective of the CCPs. So, initially we see the central counterparty is more like a clearing house, which has been set up as a part of the exchanges. We see that almost all the futures market, futures exchanges, they do have a clearing house. So, what is the main purpose of a clearing house? That's also a central counterparty. But the main purpose of the clearing house there is bring that efficiency or advantage which your forward contracts was not giving, which is the counterparty risk, right? So make sure that the default risk of the counterparties is handled more and more effectively. No one thought of introducing the CCPs as a savior of the financial system. So they were primarily created to address the default risk. But the way they handled the crisis made the regulators be aware that they can play a major role in the handling the systemic risk. So they operated well when the Lehman has defaulted, Lehman Brothers defaulted. So that is what brought in a confidence that CCPs can really make the financial markets a safer and a better place in the long term. But Before going more and more into the CCPs, let's understand a few interesting points. First of all, whether it's a CCP or any risk mitigation mechanism, let's appreciate the point that the counterparty risk is not disappearing, right? Because of CCPs or any other mechanisms, we have to understand that the counterparty risk is not disappearing. In case of CCPs, all the counterparty risk is centralized with the counterparty. So there is a lot of centralization that is happening for the counterparty risk, and there is a possibility that the counterparty risk is converted into the other forms of risk like operational risk or liquidity risk. But the risk is not going away from the system, right? So in no other mechanism also the risk goes away from the system. The only thing is it gets transferred from the parties who don't want to take risk to the parties who want to take risk. That's the only thing that is happening. So here the CCPs are showing the interest to take the risk on behalf of the various counterparties to various transactions. So we have to understand the fact that it's not a kind of a panacea which can heal all the ills. But what we see is having a CCP brings in more and more advantages compared to the disadvantages. So it can play a role in the systemic risk. But at the same time, there is a possibility that the CCP itself will fail. Then in that case, the systemic risk is even more worse. The CCP itself can fail, resulting in the systemic risk is becoming even more worse, and all the unintended consequences can very well be possible. So what is to be looked at is CCP is not something that came from an alien world. It's only a kind of a structurization. So the CCP should definitely have a structure with respect to collateralization. There should be clear-cut policies in place with respect to collateralization, settlement, risk management. So all these things, there should be clear-cut guidelines in terms of what the CCP can do in such a way that the possibility of the failure of a CCP is extremely unlikely. But as we see later, that some of the activities that a CCP has introduced as a part of the risk management, there is a possibility of a moral hazard. We'll look at as an example slightly later. There is a possibility that the moral hazard and adverse selections can very well come into picture. So people might act more and more negligently. That is what is moral hazard. And people might take advantage of the kind of an insurance that is being provided through loss mutualization, and that's where they can take advantage of the situation and convert it into their favor. So that is what we are saying. It may not be a perfect loss mutualization, but sometimes there is a possibility of a moral hazard coming in that particular perspective. So some of the important dimensions of the CCP go there. Now, let's look at what are the broad functions that the CCP gets into. Initially, when we look at when they were introduced only as an exchanges clearing houses, when they are engaged by the exchanges for clearing various transactions. So there the intention is handle the counterparty risk that happens on the floor of the exchange. So for every trade between the buyer and the seller, we used to have the clearing house. we have the clearinghouse, which is the central counterparty. So all the stages, right from the execution of the trade. So there's a trade that is executed and the settlement process. So the amount is deposited from this party to this party, and the delivery happens from this party to this party. So there is a settlement process. So this entire thing is taken care by the CCP itself. So all the contractual rights, responsibilities are taken care by the CCP. CCP used to get into a legal procedure called novation, wherein it is replacing one contract with one or more other contracts. So instead of a contract between B and buyer and the seller, it becomes two contracts or more contracts. Instead of one single day contract, it might go into different one-day contracts. So there is a kind of a replacement of one contract with one or more other contracts. That is what is going as a procedure called novation. So the CCP is coming in between the buyer and the seller in this entire process. But of course, there is a time delay. By the time between the time buyer and the counterparty interact versus seller and the CCP interact, buyer and the CCP interaction versus seller and the CCP interaction, there could be some amount of a time interval between the two processes. And that kind of a time delay is still a counterparty risk. But it could be for a very small period, because typically the exchange takes up those kind of securities which have a very high liquidity. So which means the time delay between the transaction that is happening with the buyer versus the transaction that is happening with the seller, the time delay could be very, very small. So here, as a part of the novation, the contract between the original parties, let's say buyer and the seller, initially they have got into some kind of a direct agreement. Now that direct agreement no more holds value. So which means they really don't have any kind of a counterparty risk against each other. Because the clearinghouse is coming in the middle, they have the counterparty risk only with respect to the clearinghouse. They don't have the counterparty risk with respect to each other. That is what the CCP is really playing a role in terms of reducing the burden of the counterparty risk to each of the various parties. And at the same time, the CCP is generally considered to be one of to be a very high credit worthy based organization, so very less prone to credit risk. So because the CCP is coming into picture, neither the buyer nor the seller need to be really worried or concerned about the credit quality of the counterparty. They just need to be cautious of the credit quality of the CCP, but not necessarily the credit quality of the various other counterparties they are interacting with. And a couple of other points on the same lines. CCP actually is the intermediate. So which means if the price increases, one party is benefiting, price decreases, the other party is benefiting. So the price increase or decrease really has no impact to a large extent on the CCP. That's the reason we say the CCP is not bearing much of a credit market risk, but it is exposed to counterparty risk. Means there is a possibility that either the buyer might default or the seller might default. So CCP is more and more exposed to counterparty risk rather than the market risk. And the way it tries to mitigate that particular process is it goes for financial resources, some deposits. That is what we call as initial margin as well as the variation margin. So it demands financial resources to cover that potential losses. We will look at what we call as the loss waterfall cycle, and it uses collateral wherever possible. There is a collateral usage, and that is what we are calling as a margin. There could be an initial margin which can typically perform the over collateralization. Compared to the exposure, the margin could be a higher one. So there is a kind of a over collateralization which is protecting the CCP from the default of the counterparty, and along with that there could be a variation margin which could be more from the perspective of on a regular changes in the position, the margin also keeps increasing or decreasing. So which means the counterparty risk is to a large extent converted into other forms of risk. It could be a liquidity risk or it could be operational risk. Along with that, there is one more process the CCP gets into. It maintains a kind of a fund, which is typically called as a default fund or a reserve fund. Basically, every counterparty, they try to contribute something to the fund. Because when we talk about the initial margin, the way the initial margin is collected from each counterparty is there is a kind of a probabilistic scenario. Okay, there is a 99 per whatever is the amount where there is a 99% chance that the loss will not be more than that particular amount, which is what typically we call as the value at risk. So that particular value at risk amount is what is generally collected as the initial margin, which is a kind of a cover for almost 99% of the scenarios where a member is going to default. But what about the remaining 1% of the scenarios? That 1% of the scenarios where the initial margin that is being collected from the defaulting counterparty will not be sufficient to cover the loss. And that is where we say that this remaining part of the risk is borne by the other members of the clearing house. So they share that particular risk more and more uniformly. And this is where I was bringing the possibility of moral hazard. So the company which is defaulting, it may default intentionally to get some kind of an undue advantage from the other companies which are sharing the risk of this particular counterparty. So this is where we have to ensure that the possibility of the moral hazard is completely getting ruled out. The clearing members also can partially own the CCP. So quickly looking at the different functions, they provide pricing and settlement, they perform the valuation of the OTC derivatives, and they perform the settlement. They get into the netting, they perform trade compression services. They get into collateral management where they give margin calls and go for a variation margin depending on the changes that are coming into the value of the underlying portfolio. They perform reporting function. They play a very major role in increasing the transparency of the process, and they maintain different records, and they help the regulators in supplying the different amount of information. One of the most important facilities or features that they offer is the loss mutualization, a kind of an insurance. So because it's an insurance, all the problems associated with insurance are very much possible. That is where we were talking about a possibility of a moral hazard, where a person acts more and more negligently, or there could be a kind of an adverse selection. So it's a kind of getting into it based on the homogeneity principle. So even though that particular firm thinks that its risk is much more higher compared to others, because the CCP is offering some amount of homogenization, they would like to typically become the members of the CCP to take that kind of an undue advantage. So it has to be evaluated very carefully. So what is this loss mutualization? Any excess loss that is crossing that initial margin, 99% possible scenario, that is any excess loss that is coming up over and above the initial margin collected is absorbed by all the other CCP members. So this is typically reducing the systemic risk, but at the same time, the moral hazard and the adverse selection kind of scenarios need to be handled more efficiently. And they also get into the auction process, especially whenever there is a CCP member default. All their positions are auctioned, and all the remaining CCP members should be present at that particular auction, and they should play an active role in the participation of that. Now, one major function that they perform is the multilateral netting. We have been discussing that it is more effective compared to the bilateral netting. So overall systemic risk can very well be reduced. Right? The exposure is more or less reduced. It's the central party which will bear the entire exposure. But it could create a fragmentation, and so which means we really need to assess the benefit of the multilateral netting, especially for some subset of trades, versus the benefits that are coming through bilateral. Because in many cases, when I am doing a bilateral netting, I have some kind of an advantage for monitoring my counterparty, and I can take that advantage if I can have some additional information about my counterparty. So in a multilateral netting, that is not possible because someone who is central is what is taking care of the entire netting process. So in many cases, there is a possibility that the fragmentation is coming up. So we should basically see two things. If at all I am going with multilateral netting, what is the kind of a benefit that I am getting versus the kind of benefit that I am losing because of not getting into bilateral netting. So this is where there is a suggestion of using expected positive exposure EPE as a measure of evaluation of which ones should go for multilateral netting and which ones should continue remaining as a bilateral netting. So if there is a multilateral netting, one advantage is there would be only smaller number of CCPs. So that can either improve the efficiency of the system because of smaller number of CCPs, but at the same time each CCP becomes too large that probably a failure of the CCP could create a big systemic failure. So in the initial stages, generally the move to the central clearing is very much limited, because until that particular CCP gets a big benefit, and which can come only when a critical mass of the products is clear. So in the initial stages, the central clearing may not happen that quickly, but once that minimum number gets cleared, this process becomes more and more effective. So how many CCPs should be there? So some of the important factors that are playing a role in understanding the number of CCPs, one being the judicial fragmentation. So there is a kind of a regulatory requirement that the products that are being traded by the firms located in a particular jurisdiction, the clearing and the settlement of them should happen there itself, which means The CCPs should be there at different geographies. There should be a geographical kind of existence of the different CCPs. Similarly, we see that if a product is less liquid, the settlement of it happens too much time, takes too much of a time. The closeout does not happen immediately. So, if a particular CCP is dealing in many more different kinds of products, probably some products are liquid, some are not liquid, and it may so happen that with them, whichever product is more and more liquid, that is the only product that gets cleared through the CCP, which means we can clearly say that though the CCPs want to focus on multiple products or multiple lines, the reality is they should be focused around a single asset class or even a single product type to make sure that the liquidity in that particular single product or asset class is much higher. And there is a possibility of more and more competition between the CCPs. The more is the competition, probably everyone share is being distributed by the different CCPs, which can result even in counterproductivity, because each one having only lesser number of trades to clear, that large scale insurance optimization may not come to each of the CCPs. So there should be a balance between the competition and the number of CCPs that are going to be existed in a particular locality. Now, what are the various things that are covered by a central counterparty? We look at first the OTC derivatives. So generally for the OTC derivatives nowadays they are offering clearing services. But what is observed is, because of that large volume that is required, we really see that the product needs to be more or less standardized to be cleared through a CCP. It is very much expected that the product is more or less standardized. So that's the reason the interest rate swaps, they generally are the major instruments that are cleared through the CCPs today. If the contractual features of the derivatives are very complex, if the valuation mechanism is not that straightforward for that particular derivative instrument, it becomes really tough to get it handled through the CCP. But today we see that a lot of credit default swaps, they are cleared through the CCP, though they have a complex nature, right? Though their valuation is not that straightforward, but we are seeing that they are cleared through the CCPs. But in general, if a derivative's features are more and more complex, this is where a CCP may not be beneficial. So, as we have already discussed, if the products are more and more illiquid, obviously their pricing may not be up to date, right? Because they are not traded that frequently. The appropriateness of their pricing may be questioned. They don't have too much of historical data to create a model because they are rarely traded. You don't find much of historical data to create models. So it becomes a much big pain to clear those kind of trades through the CCP. So if I have to replace those illiquid trades when the CCP member actually defaults, is going to be a much painful one. The costs associated are much higher. So which means these kind of products generally are not taken up for CCP clearance. And there could be a possibility of a wrong way risk, right? Probably if A and B have got into a contract. A has the risk from B. A is exposed to counterparty risk of B. So to protect itself from the counterparty risk of B, A takes protection from C in the form of credit default swap or something. So if B defaults, C is going to compensate A. But if the correlation between these two is much higher, which means if there is a possibility that if B defaults, the chances of default of C are also much higher, then there is no benefit that is coming up because of this kind of a CDS that is being taken. Now this is what we call as the wrong way risk. So if a clearinghouse his member is defaulting, if at all the product is having a wrong way risk, even the default of the protector is also resulting, which is resulting in a massive loss. So if at all the product is having a wrong way risk built into it, even those things may not be cleared through the CCP. So which means only a small number of OTC derivative products are more and more suitable for clearing, especially if they have a standardization built into them. Those are the products which are generally cleared well through the CCPs. So when we look at the CDS, the indices, they are very complex. So relatively difficult to be cleared through CCP. They are very much illiquid, and there is a kind of a wrong way risk that is built into them. And if I am talking about the single name CDS, which are to a large extent dealt on clearing through the CCPs, they also have a jump to default risk. So it really becomes difficult when a CCP is clearing these kind of products. So generally those products that are easy to deal, like interest rate swaps, and if they are very simple CDS, those are the ones that are very much appropriate to be cleared by the CCP, not all the kinds of trades. Now, let's move on to who are the various participants in the central counterparty market. So we talk about three major kinds of participants: general clearing members, individual clearing members, and the non-clearing members. So as the word is saying, when we talk about the non-clearing members, they really don't have any kind of relationship with the CCP. So they don't carry any kind of relationship with the CCP, but they place all their trades through a general clearing member. Who is the general clearing member? General clearing member is a member of CCP. But non-clearing member, they are not members of CCP. So general clearing member and the individual clearing members, both of them are the members of the CCP. But the major difference is general clearing members, they clear the trades of their own trades as well as the trades of the third parties are cleared through the GCMs. Whereas ICM, which is an individual clearing members, they clear their own trades. They don't clear the trades of any of the third parties. So that's the reason the non-clearing members, they really place their trades through the GCM, and the GCM would be clearing their trades as well. So basically the non-clearing members can be looked at as end users of the OTC derivatives who are channeling most of their trade through one single counterparty, which is the general clearing member. Typically, we see that the general clearing members are the large banks or dealers who have good number of counterparties interacting with them. So the structure is like this: there is a CCP, the GCM, general clearing member, and individual clearing members, they interact directly with the CCP. right? There could be many GCMs and ICMs, but they are the ones that they directly interact with the CCP. Whereas the different NCMs, which are the non-clearing members, they are associated with a GCM. And that GCM will clear all the trades of the NCM. That's the typical structure that we look at. Now, we have already mentioned that the CCP, to protect itself against the default of any of the members, it introduces some kind of financial resources to be deposited. And this is where we are bringing in the variation margin. It's a kind of an adjustment. So any change in the value on a regular basis, the value of the portfolio either increases or decreases. So it's a kind of an adjustment for the position change at regular intervals. So if at all the position value goes much and much lower than the predefined limit, it can also give some kind of margin call. Generally, the margin calls can happen at the end of the day, but in some cases, depending on the kind of a severity of the loss possibilities, even the intraday margin calls are very much possible. Especially if the price movement is so high, price volatility is so high that whatever was the margin fund that is there with the CCP as a backup of a particular defaulting party, if that is exhausted so early, then they could demand for a intraday margin call for depositing of the additional funds immediately. So, when we talk about the valuation of the variation margin, it's kind of a straightforward. So, subjectivity is much lesser in the process, and it can be deposited either in the form of some major currencies, or it could be in terms of highly liquid kind of securities. So CCPs take care of the calculation process. They value all the positions, and based on that they compute what should be that particular margin. So if at all there is a shortage, they collect the margin. If it is in excess, then they can pay the margin as well. So a variation margin is something that keeps changing on a regular basis, and on a regular basis the collecting and paying process of that is taken care by the central counterparty itself. Now, what happens if a CCP member really defaults? What are the various mechanisms under which a CCP can protect itself or protect the whole system? So, one step that they get in is all the positions of the defaulted member are typically auctioned, and every member should participate as a part of that auction process. So all the positions of the client who have defaulted, they are transferred to the surviving clearing members, which is what we call as porting. And if there are any excess losses, they are allocated, they are borne equally by the other clearing members. That is what we call as the loss mutualization process. So, if you see the different protection mechanisms that are in place by a CCP. So, every party will deposit an initial margin. That initial margin is generally as a part of the over collateralization, and we have already said that it covers the default in 99% of the scenarios. So there is a kind of an initial margin that every party sets. So when X has defaulted, its initial margin is initially used as a kind of a backup. Then every party will contribute something to the reserve fund. So even the default party has also contributed till date to the reserve fund. So the amount from that particular fund will be utilized. So which means in these two stages, it's only the defaulter's money that is being used for settling to the other parties. But even if the fund is not sufficient, right? So it's like this. At regular intervals, the CCP collects. So at the beginning, the CCP collects for each trade an initial margin is collected. And along with that, there is a reserve fund that is collected at regular intervals of time. We'll see what each of these things are. So, when a particular party has defaulted, initially the initial margin will be used for settlement. If it is not sufficient, then the reserve fund of the defaulted party will be typically used. Then, if at all there is any equity of the CCP, that equity would be used after that. Now, the other members might have, other CCP members have contributed to the reserve fund. So, all the contributions of the other members of the CCP would typically be used, which means the amount would be used from the general reserve fund where all the CCP members have contributed as a kind of loss mitigation. Then, if at all, even if this is not sufficient, the CCP can ask for additional capital contribution from the surviving members. This is where the surviving members can contribute even additional capital, and after that, the CCP's own capital can be used. Even if that is not sufficient, the CCP can use its own capital, or finally, even if all these things are not sufficient, this is where we are talking of a CCP either failing or it taking the support from the central bank of the country to provide the enough liquidity for it. So this is typically the loss waterfall cycle that occurs. So at different stages, the different amounts are being used as a backup against the counterparty default, right? So this is clearly showcasing to what extent the CCP can withstand the default of one or more other counterparties, which is one or more members of the CCP. So the major things that drive the stability of the CCP are what is the initial margin that it is collecting and how much of reserve fund that it is maintaining, because these are the ones that are driving to what extent the CCP will remain stable without failing. So that's where we'll start talking about these two aspects. So initial margin compared to the variation margin, its computation is slightly complex, because in a variation margin we are directly seeing what is the change in the value of the portfolio, and that much amount has to be either deposited or paid back. Whereas in the initial margin, it's a kind of a buffer, right? It's not a daily change in the portfolio position. So the buffer that we are looking at to cover the closing out of the positions, especially in the worst case scenario, especially when a CCP member is defaulting, what is the kind of a buffer that can really close out the positions without too much of risk to the CCP? But you have to understand that it has to be set very carefully. It can't be too high or it can't be too low. So some of the things that are considered, one is the current trade, any other existing trades of the particular clearing member, and what is the confidence level. So in what percentage of the scenarios this loss should typically be covered. Obviously, though I may require 100% of the scenarios, it becomes very, very difficult to maintain that much of a margin, because that would reduce the motivation to get cleared through CCP. Right? And what is the time period we are typically talking of? So the CCP would be exposed to the value of the members' positions after their default event. So generally we talk about a 99% confidence level and 5 days as a time period. And it primarily depends on the market risk. So typically all those trades that are cleared through the CCP, what is the market risk that is associated with them? It is very, very, very rarely linked with the credit risk. The reason being, the margin is primarily a kind of a cushion to a kind of a loss that can occur in case the counterparty is going to default. So generally it is either cash or other high liquid assets. But if you look at the other way, because the margin is collected in the form of cash or highly liquid assets, it's a kind of a higher cost for the members, because they can't use that for any other purposes. So this brings the requirement that the margin requirement can't be so stringent, cannot be so conservative. If that's the case, the people, the parties, the companies, the members don't want to get their trades cleared through the CCP. So there should be a balance. It should not be so small. If it is so small, probably the right level of risk mitigation cannot occur. And if it is so large, probably the motivation for the market participants to get their trades cleared through the CCP will actually go down. And in some cases, even there is a possibility of non-cash margins also to be deposited in terms of different securities. But what we simply say is, they cannot be rehypothecated. There is a kind of a limitation that is coming in terms of they getting rehypothecated, which means again a kind of liquidity issue comes into picture. So there should be a kind of a balancing while setting the initial margin. There should be a kind of a balancing between being competitive and incentivizing the central clearing, along with maximizing their own credit worthiness. The CCP has to maximize its own credit worthiness, but along at the same time there should be some amount of a balancing that needs to be done. So the margin cannot be too high or cannot be too low. So some of the important considerations that come into picture while deciding the initial margin, especially the volatility of the underlying market variables, because that is what we'll talk about, to what extent the price can fall within a single day or within a certain time period. So the higher the volatility of the security is, the higher the possibility of a big fall, whereas the vice versa happens if the volatility is much lesser, the chances of default or the chances of price going drastically lower are much lesser as well. And the next thing that is being evaluated is the tail risk that can come purely because of the jumps in the prices or any other market variable. And from a portfolio perspective, there is a lookout on the correlation, especially between the, if I am talking about a set of securities, what is the kind of correlation? Because if the correlation is lower, there itself the risk is mitigated among each other. They act as a portfolio to each other. So if the correlation is much lesser, obviously they become a portfolio. There is a diversification among themselves itself, and because of that reason the overall portfolio becomes less risky, which means the margin requirements also can be lesser. And the fat tail, so by looking at the distribution of the returns of each of these securities, so if at all there is any kind of fat tail that is coming up, even that needs to be incorporated into the calculation of the margin. And the multivariate behavior, right? How the two variables or two or more variables behave together, which is the correlation between the various variables. So because of that netting effects that can come, because of the portfolio effects that are possible, we should really understand the multivariate behavior of the different asset classes to understand if there is any natural reduction in the risk that is dropping up, right? So a VAR approach, generally we have said that the initial margin is typically computed based on the value at risk approach. So we are calculating the worst case loss for a set of trades, and we are accounting for all kinds of cross dependencies by taking into consideration the correlation between the various variables. But there could be a problem with pro-cyclicality as well. See, especially when the markets are very, very normal, when they are very stable, not that volatile. What we observe is the volatilities, the correlations between the various securities, that would be much, much lower. When they are lower, we have already discussed that the margins that we are collecting are much, much lesser. But the moment the market becomes more and more volatile, then even the correlations are going to go up. So whatever the margin that you have collected in the benign period, in the stable period, will not be sufficient to cover the losses that are going to crop up in the highly volatile market. So the initial margin should typically consider even that aspect as well. So the initial margin cannot be fixed, but nowadays we see the majority of the processes, the initial margin is fixed, and the different market conditions can very well cause it to increase. That is what we have discussed just now. So what is suggested is initial margin should be set to cover all but extreme price movement, means at least 99% of the cases the loss should not go beyond that. So it should cover all the losses. Forget about that small extreme losses that can crop up, but that number should not be so high that it is damaging the market liquidity because you are depositing a good number of your cash or highly liquid security. So it is impacting the market liquidity, and because of that, people may not be motivated or discouraged to use the central counterparties. And if at all the margins are very, very high, this could, especially think of a situation when the crisis is on the way, and at that particular point you increase the margin, saying that the margin can't be stable. With the economic conditions, the margin has to change, and because now the economy is going more and more volatile and it is going closer to a crisis, I want to increase the initial margin. Now if you want to increase the initial margin, that is putting even more pressure on the counterparties, right? And it is creating unpleasant knock-on effects. So especially during the crisis, they are going more and more bad phase, and on the top of it, you start demanding extra margin from them. So that is what will have a very severe consequence in the whole process. So that's one major area that becomes a concern while setting your initial margin. And the most important, another important point in the process is, in general, all the CCP members are treated equally. That is what we call as the homogenization process. So, homogenization. So while attaching a counterparty member, the credit quality of the counterparty is typically not being applied while deciding the initial margin. So it's a uniform to all the members. Then, apart from the initial margin, which is a kind of a cushion, which will cover probably the losses of the counterparty in almost 99% of the scenarios, right? So, all but the extreme cases, whatever the initial margin is being collected, it should be sufficient enough to provide the necessary backup. And along with that, what about that remaining 1% of the cases? From that perspective, the CCP talks about a reserve fund. So there is a kind of an initial contribution as well as ongoing contributions from different clearing members. So they build up a kind of a fund. So even the profits of the CCP typically go into it. All these are creating some kind of a fund. So this fund typically would used in 1% or lesser number of cases when a default of one counterpart, one of the clearing members typically occurs. Right? Now what should be the size of this reserve fund? How much should be contributed by each of the members to the reserve fund? So generally it is done not in a quantitative manner but more in a qualitative manner, where a kind of a stress test is being performed, where the assessment is looked at from this perspective. How many defaults can typically be withstood by the CCP? Is it 1, 2, 3? How many defaults of the counterparties can be sustained by the CCP? So the reserve fund is primarily computed from that particular perspective, right? So the quantitative mechanisms, okay, what is the probability of the CCP exhausting their reserve? That process becomes very, very difficult to quantify. That's the reason through the stress test we typically perform this particular process. And we have also talked about the mechanism that is traditionally followed by the CCPs, which is the loss mutualization. So if at all there is any loss that is over and above the reserve fund that is contributed by the defaulted member, we have seen in that waterfall cycle. So that is typically started, that will have an impact on the other clearing members, right? Because now they have to bear the burden of the loss of the defaulted counterparty. So if at all the losses are very, very extreme, when one counterparty has defaulted, that is being shared by all other counterparties, all other clearing members. That is what we call as the mutualization. So overall, it can reduce the systemic risk. One party is not failing that greatly. It's a kind of a homogenization. The losses are distributed equally among the various clearing members. So that is reducing the systemic risk to some extent. And as a part of a risk mitigation mechanism, even the CCP can get into a capital call. So it is collected, so it asks for additional capital from the remaining clearing members, especially if the reserve fund is also exhausted. Now this is where we can look at the moral hazard. even the CCP in a process to get more and more funds from more and more capital from the clearing members, it can get into a moral hazard problem. So this is where we talk about how much capital to be collected from the various clearing members. That needs to be capped so that the moral hazard can very well be reduced to a large extent. So, getting into all this, by now we must have made out what are the different kinds of advantages that come through the CCPs. They offer multilateral netting, especially between if we are talking about the trades between the different counterparties. So even if I enter into different trades with different counterparties, but all of them getting cleared through the CCP, all those trades can very well be netted. So, which means for a particular organization, there is a lot of flexibility that they can enter into new transactions, they can terminate the existing ones, and overall reduce the margin costs. And as we have already discussed, they offer very heavy loss mutualization, right? So, whatever are the financial commitments that are cropping up because of the default, they are shared to a large extent by the various CCP members. So, the counterparty losses are more or less dispersed to the various participants, which means the entire systemic risk can be reduced comfortably by engaging a CCP. And CCPs provide a lot of margining services, netting services, settlement functions, so they are really improving the operational efficiency of the process. They play an important role in reducing the legal risk because they act as the centralization of the rules and mechanisms. So they take care of the clearing and the settlement processes, which will reduce even the legal risk significantly. And they improve the market liquidity, and the derivatives that are traded through a CCP, because they need to be valued on a daily basis, that even brings in some amount of transparency in the process. And the other dimension of the transparency is, see, as a CCP, I can understand all the positions of all the members, right? So if there is any kind of sensitive trading information, that can very well be communicated to the relevant regulators and authorities pre-hand itself. So if any particular member has a very extreme exposure, the CCP can really act on it immediately. It can reduce or limit the trading. So that's the kind of transparency the CCP can bring in terms of the operations of the clearing members. And it can do a very effective default management. So that's one of the prime reasons the engaging a CCP or getting the trades cleared through the CCP becomes more and more interesting. Now, did the CCPs fail in the past? Though the numbers are very few, but yes, they have. And some of the lessons that we learn from that particular failures of the CCPs of the past is one thing, operational risk. So it has to be controlled. So it could be because of the processes, people, systems, whatever it is. But that operational risk needs to be controlled as much as possible. The variation margin, instead of being computed at the end of the day, there is a possibility that a significant change in the values can happen more frequently within the day itself. So the variation margin needs to be recalculated frequently, which is more or less intraday is also a necessity. Not just calculating the variation margin, even the call and collection needs to happen more and more frequently. And when you are computing how much should be your initial margin and how much should be your reserve fund, create a model which is more and more resilient to large negative asset shocks. If the prices fall drastically, perform that kind of stress test, and even the correlation dependency between the variables also perform it at the extreme. So finally compute what should be your initial margin and reserve fund. These are some of the things that have resulted in the failures of the CCPs earlier. So the lessons from these can really help in making the CCPs much more better and effective. Now, we have talked about homogenization, which we are clear of now. See, when we talk about any clearing process, we know that it improves the fungibility of the contracts, counterparties become interchangeable, and overall the systemic loss is reduced because there is a loss mutualization that happens, right? But this is where, when I bring in the homogenization, we see that the firm which is more and more riskier, their costs are reduced, and on the other side, the firms which are more and more stable, their costs are getting increased. So this homogenization might be more and more beneficial for the riskier firms because they might not get that advantage in a bilateral contract. So they can very well get the advantage when they are going through the CCP. So the heterogeneity in terms of credit quality, it will really diverge the interests of the members. So they may not, if the credit quality is being considered by the CCP, then they may not be interested in getting their trades cleared through the CCP. So which means, in general, we see that almost all the players with similar kind of credit quality, they get associated with a CCP. And homogenization is actually reducing the asymmetrical information problem. I know more about the counterparty. I want to take an advantage of the knowledge I carry about my counterparty in the trading process. And it allows anonymous trading and settlement. So overall, if we talk about the different institutions that are engaging themselves, they really need to be aware of the creditworthiness of the counterparty, which is the CCP, but they really don't need to be aware of the creditworthiness of the other members. The reason being, the trade is between the CCP and the member. So, who is the other counterparty? That party is completely anonymous to the other party. So, that is the kind of anonymous nature that we are bringing in. And every institution, it really needs to be aware of the counterparty risk or credit worthiness of the CCP, and it need not focus on the members. So as long as the member is posting the relevant margin, even if the credit quality of them is declining, it is generally ignored by the CCP. So this is where a poor quality institutions, they can really create bigger positions more cheaply. This is what is a possibility of a moral hazard that can very well come up into the process. So the CCPs are getting more and more popular with those counterparties which are having below average risk management abilities and which have weaker credit qualities, because this CCP is creating a kind of a homogenization where it is not checking for the credit quality of the counterparty while getting the trades cleared through it. As long as a relevant margin is being posted, as long as Now the variation margin, reserve funds are contributed, nothing else is being evaluated. Now, what if a CCP fails? Generally, when the market is very, very volatile or during the crashes, I see that there could be a possibility that a CCP can fail. And it's so very intensive that it can lead at least to a temporary breakdown of the market. Not just the domestic market, but it can have even a global implication as well. But though the probability of the failure is much, much lesser, but in case it occurs, the consequences could be much, much severe even compared to the failure of one single large bank. So the severity is much, much higher. And there is a possibility that the liquidity can be injected by the central bank. That's the only way the catastrophic failure can be avoided. But that means all the taxpayers' money is being used to bail out a CCP. It's the same way even the taxpayers' money was used earlier to bail out a bank, a large bank failing. The government has bailed out, the central bank has bailed out by using the funds of the taxpayers itself. Now that is a very dangerous thing. That can create a kind of an impression among the CCPs that it is too big to fail, and even if it fails, it would be bailed out by the central bank, and that could also create a kind of problem with the way the members of the CCP can behave. So they may be negligent to the various activities. Because even if the CCP fails, they would be bailed out by the central bank. That is what we are calling as a possible moral hazard in the process. Now, what are the real hindrances that are coming up? What are the challenges that are coming up that are obstructing the growth of the CCP markets? As we have already looked at earlier, they are becoming more and more jurisdiction specific, right? And OTC market, they are becoming more and more customized, which means their valuation process becoming more and more complex. They are becoming more and more illiquid. Clearing them through the CCPs becomes much, much difficult. So if the complexity of the product is much higher, even an adverse selection process can come into picture, because dealers generally have more knowledge about the risk compared to the other party. And if at all I am moving the OTC derivatives to a CCP, now the margin requirements are much higher. So which means the liquidity cost is coming up, because I'm blocking the liquidity. All the highly liquid instruments are being deposited as the margins, and even if the securities are deposited, they can't be rehypothecated. So there is a kind of a cost that is coming on the liquidity because of the initial margin requirements, and because of the reduction in the rehypothecation as well, the liquidity is getting more or less impacted very badly. The netting benefits are getting lost, and CCPs are also exposed to operational risk. What if a CCP fails? And what if there could be a fraud at the CCP? So those kind of operational risks are not an exception to the CCPs as well. And if at all a CCP breaks down, probably the impact could be very much catastrophic compared to a failure of a single large bank. And there is a possibility that all the market participants will start more and more negligent ways of behaving, because they are very much clear that they are shielded. So it can have an impact in potentially unintended ways as well. So those are some of the reasons why the CCP is the growth of the CCP market is typically not. I mean, those are some of the blockages that could typically come up for the growth of the CCP market. Now, this is what I wanted to offer you as a part of this session. So we have looked at all these things. So you can quickly go through them. If you have any further queries or clarifications regarding any of these topics, you can get in touch with the number that I have provided below, or even you can send in an email to me. I can get back to you. Thanks a lot for listening to this session. Thank you very much.